Goldman Sachs just dropped a bombshell, cranking up their 2026 gold price forecast to a jaw dropping $4,900 an ounce. No, that's not a typo. $4,900. That's a huge leap from where we are today, even with gold already knocking on the door of the $4,000 level. This isn't some random analyst taking a wild swing. This is Goldman Sachs, one of the most powerful investment banks on earth. They've just put a number on the table that's making everyone on Wall Street and beyond do a double take. But before you start measuring your car for gold bars, you have to ask the most important question. Is this a real signal of a once in a generation rally driven by massive central bank buying and a wave of investor fear? Or is this just classic Wall Street hype, a masterfully told story designed to suck retail investors in at the very top? That's the multi-trillion dollar question. And we're not just going to read you the headline, we're going to get to the bottom of it. We've got the official Goldman Sachs report, and we're going to pick it apart to figure out what's really happening. We'll dissect their arguments, kick the tires on their assumptions, and by the end, you'll have a clear, no-nonsense idea of whether $4,900 gold is a real opportunity or a dangerous fantasy. So let's get down to it. Why does it matter so much when Goldman Sachs makes a call like this? In the world of finance, some voices are just louder than others. Their research doesn't just comment on the market, it moves the market. When Goldman releases a new forecast, hedge funds, pension funds, and every other major player listens. Their reports are packed with complex models, private data, and access to a global information network that most of us can only dream of. So, while no forecast is ever a sure thing, a call this big from a bank this influential makes everyone sit up and pay attention. Now, for the details of this bombshell report, Goldman didn't just pluck this number from nowhere. They boosted their price target for December 2026 from an already high $4,300 an ounce all the way to $4,900. That's a $600 jump, sending a clear message that the trends they're watching have gotten even stronger than they first expected. What makes this so compelling, and honestly a little startling, is the conviction they have. Goldman stated that the risks to their already high forecast are, and I'm quoting here, still skewed to the upside. In simple terms, they think there's a better chance the price goes even higher than $4,900 than the chance it falls short. They're seeing what they call sticky demand from two of the heaviest hitters in the gold market, central banks and Western investors. This isn't about short-term speculation. In fact, Goldman's report points out that the positions of speculative traders have stayed broadly stable. This rally, which has seen gold rocket up a staggering 51% so far this year, isn't being driven by fast money jumping in and out. It's being powered by a deep fundamental change in how nations and major investors are protecting their wealth. That's a huge distinction. It suggests this might not be a bubble waiting to pop, but a total repricing of gold for a new global reality. The report is basically arguing that the whole foundation for valuing gold has been lifted. To figure out if they're right, we have to look past the headline and get into the engine room of this forecast. What are these powerful, sticky forces that have Goldman so convinced gold is shooting for the moon? All right, this is the heart of it. You don't call for a price this high without some serious firepower to back it up. Goldman's case is built on a few interlocking pillars. Let's break them down, starting with the biggest whale in the market. Driver number one, the unprecedented central bank gold rush. The single biggest force holding up the price of gold right now is the relentless, insatiable, and historic buying from the world's central banks. That's not an exaggeration. For the last few years, central banks have been hoarding gold at a pace we haven't seen in decades, and it doesn't look like they're stopping anytime soon. Put yourself in their shoes. For decades, the US dollar was the undisputed king of global reserves. But now we're in an era of geopolitical friction and strategic rivalry. Countries are actively trying to depend less on the dollar, a process called de-dollarization. They've seen how the dollar can be used as a political weapon, and they want an alternative. Gold is that alternative. It's a neutral asset that no single government controls, and it carries no risk of being defaulted on. It's financial insurance against sanctions and currency wars. So who are the main buyers? It's mostly emerging market central banks. Countries like China, India, and Turkey are consistently adding to their reserves. The People's Bank of China, for instance, has been on a buying spree for 11 months straight. Recent surveys of central bankers lay it out in black and white. An incredible 95% expect global gold reserves to keep rising over the next 5 years, and 43% of them plan to increase their own country's holdings within the next year. This is a seismic shift. The dollar's share of global reserves has already dropped from over 70% at the start of the century to around 58% today, while gold's share has nearly doubled in that same time. Goldman's forecast has this trend baked right in. They expect central banks to buy an average of 80 metric tons in 2025 and another 70 tons in 2026. They figure this one factor alone, this structural shift by sovereign nations, will account for a massive 19 percentage points of their projected price increase. The key thing to remember is that central banks aren't day traders. They buy for the long haul. Their buying effectively pulls physical gold out of the market for good, tightening the available supply and creating a strong rising floor under the price. Driver number two, the return of the ETF investor. While central banks provide the solid foundation, the next major driver is the reawakening of the Western investor, mainly through gold exchange traded funds or ETFs. For anyone not familiar, a gold ETF is a fund that trades on a stock exchange, but its shares are backed by real physical gold stored in a vault. It's the easiest way for anyone to get exposure to the price of gold without the headache of storing physical bars. Because of this, the money flowing into and out of these ETFs is a great real-time gauge of investor mood. And right now, that mood is shifting in a big way. After a quiet period, investors are flooding back into gold ETFs. September saw record-breaking inflows, with billions in new cash pouring into these funds. The World Gold Council reported that these inflows are pushing the total assets in gold ETFs to near record highs. So why now? The answer is simple: fear. Investors are looking for a safe haven from a perfect storm of risks. They're worried about stubborn inflation that central banks can't seem to tame. They're worried about a potential recession as higher interest rates bite, and they're worried about rising geopolitical tensions and political instability around the globe. Every headline about political gridlock or international disputes just adds to this anxiety, chipping away at confidence in traditional assets. When trust in currencies and governments gets shaky, gold starts to look very attractive. Goldman Sachs points to these robust ETF inflows as a key reason for their upgraded forecast. They believe these investors are in it for the long haul. Their model predicts that as the Federal Reserve eventually starts cutting interest rates, Western ETF holdings will keep climbing, adding about 5 percentage points to their price target. This is the fear trade in full effect, and it's like pouring gasoline on the fire. Driver number three, the perfect macroeconomic cocktail. If central banks and ETFs are the demand, this third driver is the environment that makes that demand so intense. It's the mix of economic factors creating the perfect conditions for a gold rally. First up is monetary policy, especially from the US Federal Reserve. Gold doesn't pay you anything to hold it. Its biggest competition is cash or bonds that do. When interest rates are high, the opportunity cost of holding gold is high. But when rates fall, that cost shrinks, making gold look a lot better in comparison. The market is currently betting that the Fed is nearly done hiking rates and will start cutting soon. Goldman's forecast specifically assumes the Fed will lower rates by a full percentage point by mid-2026. And lower rates usually mean a weaker US dollar. That's the second ingredient. It's a classic seesaw. When the dollar goes down, gold tends to go up. Because gold is priced in dollars, a weaker dollar makes it cheaper for buyers using other currencies, which cranks up demand. A falling dollar also pushes investors and even central banks out of dollar assets and into alternatives like gold. Finally, you have the ghost of inflation and general economic anxiety. Even with all the rate hikes, people are still worried about prices. Investors are buying gold as a traditional hedge to protect their purchasing power. The link between uncertainty and the gold price is the strongest it's been in years, showing just how deep the anxiety runs. When you mix these three things together, expected rate cuts, a weaker dollar, and widespread uncertainty, you get the perfect cocktail for a powerful and lasting gold rally. This is the economic backdrop that props up Goldman's entire argument. Okay, this all sounds incredibly bullish. Before we get carried away and start planning our gold-plated retirements, it's time for a reality check. No forecast this bold is risk-free. The road to $4,900 won't be a straight line, and there are serious headwinds that could blow this rally apart. So let's play devil's advocate and look at what could derail this gold train. Headwind number one, the long shadow of the Federal Reserve. The entire bull case leans heavily on the Fed cutting interest rates. But what if they don't? Or what if they don't cut as much or as soon as everyone hopes? This is by far the biggest single risk to the price of gold. Imagine a world where inflation just won't go away. Maybe wages stay high or another supply chain crisis pops up. The Fed might have to keep interest rates higher for longer to finally get inflation under control. Some analysts are warning that a strong US dollar rally could be around the corner and gold won't be able to ignore it forever. Higher for longer interest rates would be poison for gold. It would make interest paying bonds much more attractive and would likely strengthen the US dollar, hitting gold with a nasty 1-2 punch. Plus, any surprisingly good economic news, like strong job numbers, could kill the safe haven demand. If it looks like we're heading for a soft landing instead of a crash, that panicked rush into gold could reverse just as quickly. The future of the gold price is completely tied to the decisions made in Washington, D.C. Headwind number two: King Dollar's potential comeback. While many are predicting a weaker dollar, that's not a guarantee. There's a reason the US dollar is still the world's main reserve currency. In times of true global crisis, money often flees into the dollar and US bonds, which are seen as the ultimate safe havens. It's called the dollar smile. The dollar gets strong when the US economy is booming, and also when the rest of the world is in a deep crisis. So while geopolitical tension is helping gold now, a major escalation could paradoxically spark a flight to safety into the dollar. A surging dollar would act as a powerful brake on the gold rally. It's a tricky dynamic. This rally has been breaking some of the usual rules, but those old market correlations have a funny way of snapping back into place. Headwind number three: demand destruction and overheating. Finally, we have to ask if this demand can even last at these sky high prices. Take the central banks. Yes, they're buying in huge amounts, but even they have budgets. The rapid price spike might force them to slow down. Some data already hints at a slight slowdown in monthly purchases, which could be an early sign that even central bankers are getting a little price sensitive. The same goes for physical demand from consumers, especially for jewelry. These buyers are very sensitive to price. At some point, $4,000 or $4,500 an ounce is just too expensive, and demand from this part of the market will drop off. Then there's the risk that the market is just overheating. Gold has shot up 51% in a short time. That kind of vertical move naturally makes people wonder about a bubble. Technical charts show the market is extremely overbought. While the reasons for the rally are strong, no market goes up forever without a breather. A sharp pullback from profit taking is a very real possibility, especially as the price gets close to big psychological numbers like $4,000. The question is whether a pullback would just be a dip before the next leg up or the start of something worse. It's impossible to talk about gold as a safe haven asset today without addressing the elephant in the room: Bitcoin. For years, people have called Bitcoin digital gold, a 21st century alternative for protecting wealth from currency printing and financial chaos. The reasons people are interested in gold are mirrored in the crypto market. So, how do they compare? Gold's appeal is its thousands of years of history, its physical nature, and its accepted role in the central banking system. It's the original hedge. Bitcoin is the new kid on the block. Its value proposition is based on its decentralized network, its fixed supply, and its existence completely outside the traditional financial system. The big drawback, of course, is its insane volatility. Gold can make sharp moves, but they're nothing compared to the wild swings of the crypto world. Bitcoin is also much more exposed to regulatory risks and digital theft. But here's what's interesting: the same forces driving gold higher, a weaker dollar, inflation fears, and a general mistrust of government finances, are the exact same arguments used to support Bitcoin. They are both thriving in the same environment of uncertainty. Instead of seeing them as direct competitors, it might be better to see them as complementary assets. They appeal to different people for similar reasons. Some investors are even splitting their safe haven money between the two. Gold offers stability and history. Bitcoin offers innovation and wild upside potential. The fact that both are rising at the same time isn't a coincidence. It's a powerful sign of a widespread loss of faith in traditional money, with people now choosing between the ancient lifeboat of gold and the new digital one of Bitcoin. Okay, so we've torn apart the bull case and kicked the tires on the bear case. Where does that leave us with Goldman's massive $4,900 call? Is it a realistic opportunity or just hype? The reality is that the foundation for a much higher gold price is definitely there. The core drivers Goldman points to are real and structural. The de-dollarization trend pushing central banks to buy is a story that will play out over decades, not months. The economic and geopolitical fears that are sending investors to ETFs aren't going away tomorrow. The case for a higher gold price is solid. Now, hitting $4,900 an ounce by the end of 2026 is aggressive, but it's not impossible. It would require today's uncertain environment and the expectation of easy money to continue. The path will almost certainly be a roller coaster. Expect sharp pullbacks along the way, especially if the Fed gets tough or if a crisis causes a sudden stampede into the US dollar. For you, as an investor, this isn't a signal to blindly plow your money into gold. It's a signal to pay very close attention. The things to watch are crystal clear. Keep an eye on the monthly reports of central bank buying, track the weekly flows into the big gold ETFs, and most importantly, hang on every word from the Federal Reserve about interest rates and inflation. These are the signals that will tell you if this golden rally has legs. Goldman Sachs has fired the starting gun, and they've made it clear they think this race has a long way to go. The evidence suggests they have a very strong case. If you got some value from this breakdown and want to stay ahead of the big market moving trends, do us a favor and hit that subscribe button and ring the notification bell. We're here every week, cutting through the noise to bring you analysis you can actually use. Thanks for watching.